Hi, Tom Lydon here in San Diego at the Schwab IMPACT Conference, and I'm here with Matt Bartolini, head of SPDR Americas Research at State Street Global Advisors. It's great seeing you, Matt.
Great seeing you too, Tom.
I like to nerd out with you because we always talk about all the ins and outs of ETFs and trading and everything. But one thing we want to talk about today is the total cost of ownership of an ETF. ETFs are cheaper than ever. Trading costs have gone down.
Yeah.
So what more do we have to worry about?
Well, it's just understanding the components. So we've developed a formula that really break it into the two main variables. You have issuer control costs and then you have investor control costs. Issuer control costs are things like expense ratio, fees, but then you also have portfolio management efficiency. How well does the manager track the intended benchmark? But also, what's the securities lending program? How much revenue is passed back to the fund? How aggressive is the portfolio? And then all of those securities lending revenue can offset some of the expense ratio.
Yeah.
And then you have your investor control costs, things like bid-ask spreads, but also commissions. While some may have gone away, they're still out there. So understanding which one you want to play more emphasis on how you trade and how often you trade and how much you turn over your portfolio can actually have a different result in the overall total cost of ownership of an individual ETF.
Yeah, so you ran through a lot there.
Yeah.
Obviously, expense ratio, yes, that's controlled. You know if it's 9 bips or it's 20 bips, we know what that is. You touched base on spread, bid and ask spread. During times of volatility, isn't it true that some ETFs have greater spreads?
Yeah, that's right. So that's why we advocate for a regime-dependent approach, which takes a little bit more due diligence. But you basically want to understand how do bid-ask spreads react during periods of volatility, but also tranquility, because you're going to have a different behavior. So maybe some ETFs that trade massive amounts of liquidity, their bid-ask spreads will be consistent during any time of volatility, and that can be a benefit and additive to the portfolio and actually lower your total cost of ownership overall.
Right, and isn't it true too that those ETFs with the lowest expense ratios don't always have the tightest spreads?
That's right. So sometimes you pay higher fees for lower costs. So some higher fee funds from an expense ratio perspective actually might be lower cost from a TCO perspective because their bid-ask spreads are tight, consistent, and you can trade them with confidence in any type of market.
Yeah, and you touched on securities lending. That's kind of one of those hidden secrets in the ETF world where you can actually lend out securities within the portfolio. There's revenue that's gained for that. And in many cases, the advisor has the choice whether they're going to keep it themselves, give it 100% to the shareholders, or have some type of split, correct?
Yeah, so there's two types of securities lending, and this is where you can kind of nerd out a little bit. There's inside lending and outside lending. Inside lending is the fund lending out its securities. You can gain revenue from that at the fund level, and that offsets the expense ratio. But depending on your custodian, if you're an institutional investor in some wealth management platforms, you can actually lend out shares of the ETF and actually earn revenue on that. So I think the ETF structure really allows for a lot of customization in a way to improve your total cost of ownership beyond just looking at a single expense ratio.
Yeah. So we always, 95% of the time, concentrate on an expense ratio. As advisors who are allocating more money to ETFs, do we need to do a better job of understanding these other costs?
Yeah, I mean, look, expense ratios are really important. They're part of that total cost of ownership equation. Yeah. But I think what we need is just more and continued education on those individual components and how do you perform analysis depending on what the ETF strategy is, what your rebalancing program is, but then also what's your use case within the portfolio? Is it something that's core or something that you're going to be using more tactically? So all of it is just more education, and that's what our firm is really trying to lead on, and I think we're doing a good job, but with anything education, there's always room for more.
You're doing a great job, and thank you, and great seeing you again, Matt.
Great seeing you too, Tom.